Welcome back to the channel. Right now, there's a specific group of landlords who are feeling surprisingly positive about the property market. In fact, around 89% of this group say they plan to stay invested and feel confident about where things are heading. This insight comes from a survey carried out by Barclays, focusing on landlords and buy-to-let investors. What's particularly interesting is that confidence seems to depend heavily on how a landlord structures their property portfolio. I'll break that down in this video because the way you set things up can make a big difference when dealing with challenges like EPC requirements, the Renters' Rights Act, and other ongoing changes. Before we get into it, if you're new here, make sure you subscribe to the channel and turn on notifications. Join the growing community who follow for updates on house prices, interest rates, and property investment strategies. Also, don't forget to hit the like button. It really helps the video reach more people and supports the channel. Now let's talk about what's happening. I often cover the fact that many landlords are currently leaving the market. That trend is still ongoing. There's been a rush recently, especially with deadlines around Section 21 notices, and while it might be tight timing-wise, some landlords are still pushing to act before changes fully take effect. The combination of regulatory pressure, potential EPC changes, and broader sentiment has led quite a few to exit. However, Barclays' data tells a slightly different story for a certain type of landlord. They've surveyed a large base of clients, including those with buy-to-let mortgages through both Barclays and their associated lenders like Kensington Mortgages. The key finding is this: landlords who hold their properties within a limited company structure tend to be far more confident about the market. From my own experience, I can see why. I own properties both personally and through a limited company, and the two setups do feel quite different. Running a limited company involves more structure and responsibility. For example, there are formal requirements like submitting an annual confirmation statement, something straightforward but still an obligation. There are also additional steps when arranging mortgages, which tend to be more complex compared to personal ownership. Because of this, landlords operating through companies are already used to dealing with extra layers of administration. So when new regulations or requirements come in, they may see them as manageable rather than overwhelming. There's also a strategic angle. If fewer landlords remain in the market, competition decreases. For those who stay, that can create opportunities for better returns. And this lines up with the survey results. According to Barclays, 89% of landlords using a limited company structure feel confident about the market. That's notable, especially when you consider that house prices have been relatively flat for a couple of years, and there's been ongoing negative sentiment around landlords. Despite that, this group remains optimistic, and I tend to agree with that outlook. Personally, I don't find managing properties within a company any harder than owning them in my own name. If anything, it encourages a more organized and disciplined approach. Looking deeper into the survey, around 84% of these landlords expect rental yields to improve over the next year. That expectation makes sense. Rents are projected to rise, and when rental income increases while property supply tightens, yields naturally follow. About 80% believe tenant demand will grow. Again, that aligns with what we're seeing. As more landlords exit, the number of available rental properties decreases, while demand remains strong, or even increases. Even though some properties are being bought by first-time buyers, the overall rental supply is shrinking faster than demand. From a landlord's perspective, higher demand can also mean more choice when selecting tenants, which becomes especially important given concerns around payment reliability and new regulations. On the flip side, 77% of respondents are concerned about interest rates. That's currently their biggest worry. External factors, including global tensions and rising oil prices, could push inflation higher, which in turn may impact interest rates. If borrowing costs increase, it directly affects landlords, especially those on interest-only mortgages. To put it simply, if your rate doubles, your mortgage payments double. If it triples, your costs increase dramatically. So it's understandable why this is a key concern. Additionally, 81% expect their operating costs to rise. There's likely to be more administrative work, additional compliance requirements, and new systems like landlord registration databases that may involve fees. However, many landlords believe that rising rents and strong demand will help offset these increased costs. Overall, while there are definitely challenges ahead, this group of landlords sees enough opportunity to remain confident. One final point worth mentioning is the difference in tax efficiency. Owning property personally has become less attractive from a tax perspective. In contrast, a limited company structure can offer better efficiency if set up correctly, which is another reason why more investors are leaning in that direction. So that's a more positive perspective from a certain segment of the market. If you're already investing through a limited company, do you agree with this outlook, or do you see things differently? Let me know your thoughts in the comments. And if you're considering becoming a landlord, it's worth understanding how to structure your investments properly from the start. Thanks for watching. Don't forget to like, subscribe, and check out the other videos on the channel.